the depression of 1890, the collapse of 1929, the dot-com bubble of 1999, the global financial crisis of 2007, and most recently the coronavirus crash in 2019-20s. This cycle predicted each of these events. And what is most surprising, it was published back in 1875, that is, about 150 years ago. That is, someone else was then able to predict all the major and even minor crashes that would occur. Can you imagine that? If you knew all this, you would be able to plan all your investments for the next 50 to 100 years. If you had followed this cycle, you would have sold assets just before the peak of the 2007, bought again at the bottom in the 2009, then sold again at the peak of the 2020, and bought the attack again in the 2023. You would get about 700% of the profit on the S&P 500 index. And of course, this cycle also works for other assets that correlate with the stock market. If you applied it to Bitcoin, for example, and started buying and selling it from the year 2017, based on this cycle, then your profitability would be 3,549%. And you may be wondering, what are the risks? If something so good exists, why hasn't everyone around us become billionaires yet? And yes, you're right, there are reasons why not everyone has become a billionaire yet. That is why in this video, I will tell you what kind of cycle it is, how it is connected with land and real estate. Then, I will directly explain the risks and reasons why not everyone has become a billionaire yet. And also tell you how you can circumvent these risks in order to maximize profitability based on this cycle. Let's start to figure it out, but first don't forget to pass the fare. The fare we have is one like Cohen. Passed. Thank you so much for your support. First, let's figure out what kind of cycle it is and how you can make money on it. First of all, I want to tell the story of how I first invested in Bitcoin. I bought it at the end of 2013, when it cost about $1,200. And then I lost most of my investments when I sold after the price fell almost tenfold. I sold everything and did not return to Bitcoin until 2017 year. And if I had known that we were at the peak then, I would have waited until the price fell, and only then would I have invested. But in fact, if you are just starting out, I would recommend just investing a small amount right away, no matter what. Because the time spent in the market will give you experience, especially at the beginning. Staying out of the market when it is at overheated values can help you maximize your profits. But I believe that the experience and understanding that you will gain by participating in the market is much more valuable than the extra $100 that you can lose, because this is how you will understand the emotions that a person experiences in the process. And you will be able to apply this experience during the next recession. I did it. But if you have already invested some time, then the ability to properly adjust to cycles becomes extremely important. And it is this cycle that will help you maximize your income. So what kind of cycle is this? It's called the Benner cycle. And it was compiled in 1875 year by a famous predictor of commodity markets, named Samuel Benner, who was well known for his forecasts back in 1800 years. And perhaps you have already seen this graph, which I am showing now. It is published on social networks from time to time. The reason this cycle is surfacing publicly again is because people are starting to notice how frighteningly accurate it turned out to be. The Benner cycle predicted the depression of the 1890s, the collapse of the early 1990s, the panic of 1910s, the Great Depression of the 29th, and so on and so on. And more recently, this chart showed a peak in 2019 and a fall in 2023. Not bad, considering that this forecast was made 150 years ago. How does it work? When Benner created this graph, he believed that time has a pattern. He believed that this pattern worked regardless of wars, panics, or elections. Later in the video, I'll tell you why this is a bit of a mistake. To uncover this cycle, he used three main data sources. First, historical price data, IDS data on past prices. Secondly, weather patterns, how the weather changes from year to year. No idea how it works, but that's what he did. And thirdly, astronomical and astrological phenomena, for example, the cycles of the sun and moon, and how they affect human prejudice and behavior. Through this, he created his cycle. And Benner became known as one of the most accurate economic predictors of his time. He was so good that even Edward Dewey, director of the Cycle Research Foundation, analyzed his forecasts for 60 years and called them the most outstanding price forecasts in history. So, how do you actually read this loop? If you look at the cycle graph right here, you'll see three main horizontal lines. Line A, B and C. Line A. This is the topmost line. It shows the years in which panics occurred and in which they will occur again. And here we are talking about a complete collapse, very loud collapses that greatly affect the economy. Line B, IDS, the middle line, shows years of prosperity, high prices, and a good time to sell stocks and other assets of all kinds. This is the best time to sell stocks, real estate, goods, land, because it is at this moment that all this is expensive. After that, there is often a recession, but not necessarily a complete collapse with a big impact on the economy, as on line A. Most often, this is caused by the overvaluation of the stock market, and not by any serious crises. Both line A and line B are a good time to sell and save capital until the market reaches the bottom. According to the Benner cycle, the bottom comes on the C line at the bottom. This line shows years of hard times, but also low asset prices. This is a good time to buy stocks, land, goods, real estate, and other things. Then it remains only to wait for the rise to sell everything at a new peak. This line indicates the right time to buy at a low price. For example, the last such moment was in 2023 year. And indeed, Bitcoin then reached the bottom, as well as the total capitalization of alt Bitcoins. Here is an example of a Benner loop. 2019, line A, panic, then COVID, the collapse of the markets. Line C, 2023 year, all this is cheap, a chance to buy. And line B, this is already 2026 year, everything is growing, it's time to sell. The idea is simple. Buy when everyone is afraid of line C and sell when everyone is greedy. Line A and B. Now let's discuss the risks associated with the Benner cycle and really understand, if this cycle is so good, then why hasn't everyone become billionaires yet? First of all, the reason you haven't heard of a lot of people who have become ultra-rich thanks to this cycle is that it's not very widely known. It hasn't become popular yet, and like any prediction model, this one has an error in accuracy. This is especially true for determining peaks in the stock market. Often the forecasts for the Benner cycle are a year earlier or a year later. Nevertheless, he accurately predicted the depression of the 1890s, the panic of the 1990s, the Great Depression of 1929, and so on, and so on. And more recently, this cycle showed a peak in 2019 and a recession in 2023. This is not bad, considering that the forecast was made 150 years ago. Here forecasters can't correctly predict the weather for tomorrow, you know. This cycle also warns of the next recession, in 2026, which coincides with the peak of the 18-year land cycle, and the downward trend to the beginning of the 2030s. The 18-year land cycle in the past peaked in 1990, then in 2008, and if we add 18 years to 2008, we get 2026. Interestingly, the land cycle and the pattern of recession panic coincide, which increases the plausibility of the Benner cycle, but slightly corrects it. So in general, I believe that if you take into account a small margin of error and include it in your long-term investment plan, you can still earn a large amount. Personally, I combine this cycle with other reliable indicators to minimize this error. These are, for example, technical indicators such as the Shiller coefficient, the ratio of total debt to GDP, the inversion of the yield curve, and behavioral indicators. For example, an ant in a store says it's time to buy stocks or Bitcoin. This is my favorite, most reliable indicator. Usually, such an indicator works for about 5 to 8 months before the collapse. Let's take a brief look at each of these indicators. The Shiller coefficient measures how overvalued or undervalued the market is. It is calculated by dividing the market value of the S&P 500 index by its average profit. And now we have this coefficient at the level of 34 and 2. Despite all the recent events, this figure is still higher than in 1929. However, it is already lower than it was during the dot-com bubble, Then it was 43, as much as 31 hundredths. At the peak of 2021, it was 38.58. I would say that it is worth selling when it approaches the marks of 40 and above. But, of course, it needs to be counted with other indicators. One of them. This is the ratio of total debt to GDP. And here it should not be confused with just external debt. Total debt includes household debt, private debt, and public debt. A high debt to GDP ratio shows how over-indebted a country is. And the higher the debt burden, the more likely it is that the economy will get worse. At the moment, the ratio of total debt to GDP in the United States is 270%. At the same time, the ratio of public debt to GDP is 124%. Don't confuse these two things. And, in my opinion, this is a fairly high indicator. 270%. Especially if you remember that in 1999, this ratio was 260%, and in 2007, 350%. Ray Dalio, the founder of the world's largest hedge fund Brickwaters, says it's time to start selling. If this figure is approaching the 300% mark. The third indicator, which is also worth paying attention to. This is the inversion of the yield curve, which reflects the difference between short-term and long-term returns. If the yield curve goes from flat to inverted, this is a very strong signal that the market may collapse over the next 8 to 12 months. And this indicator is usually extremely accurate. In simple words, the inversion of the yield curve occurs when short-term interest rates become higher than long-term ones. This is usually a strong signal to the economy that there will probably be a recession within 8 to 12 months. Since 1955, every recession in the United States has occurred after the inversion of the yield curve. It is interesting what is happening to it now, because at the moment the curve has moved from inverted to flat. This happened due to the fact that the steepness of bond yields rose sharply. And it started after Liberation Day. The yields of 2- and 10-year bonds began to move so as to level off after the inversion. That's why the curve has straightened out, started to come out of inversion, and the spread has become positive. What does this mean? Previously, investors tried to stay either in short-term bonds or in protective assets like gold. But now the curve is normalizing, which means that capital outflow from protective assets is quite possible. Perhaps that is why we are seeing a drop in gold and gold sales even from China. In any case, traders are now saying that the next black swan of the market may be a sharp increase in the steepness of profitability. And its decisive exit above zero. It affects absolutely everyone. And if we apply the same concept to the banner cycle, then we can see the following changes. The first row marks the peak of the real estate cycle from the very beginning, that is, the final recession, and row B. This is the mid-peak and mid-recession, that is, less destructive. So, what was known before? The fact that row A marks the peak of the real estate cycle from the very beginning, that is, the final recession, and row B. This is the middle of the peak, the middle is the recession, that is, less destructive. However, interestingly, according to new data from the updated 18 to 6-year real estate cycle, since the Second World War, everything has changed for the banner cycle. That is, since 1945th year, the final peak of the cycle switches from row A to row B. In other words, after the Second World War, row A now indicates the middle of the cycle, that is, a less serious recession. And row B now indicates the end point of the peak, that is, a more severe recession related to the land market. Thus, we can say that the Second World War actually shifted the timings between the final peak and the middle peak. Why did this happen? Because military policy can easily affect the land market, its ups and downs. The fact is that during the Second World War, states changed priorities in the allocation of resources. They changed the level of public spending, and they changed the priority of economic tasks. That is why it is very important to be aware of such changes. This will help you understand when there will be a strong change in market dynamics or in cycles. Now, looking at the dates on the banner cycle graph, you can see that row B indicates the next peak in the real estate cycle. And this is 2026th year. Given that the banner cycle can be wrong for a year, and based on all of the above indicators, This peak can be expected at the end of 2026 or in the middle of 2027.